As a certified financial planner, I believe in these 3 financial concepts for families who are saving for the future. Number 1, you should be saving in assets that you own, control, and manage, not the US government. Number 2, your savings should be balanced. You should have risk assets with rate of return where your asset can go up, but it also can go down. And you need to balance that with safe, guaranteed assets that have no loss. And lastly, every family should own an asset that's completely invisible to the US government for income tax purposes. My beliefs have helped me shape successful financial plans for hundreds of my clients over the past 15 years. Let me show you why I believe what I do. Number 1, saving in an account that you own, control, and manage is far better than that of the US government. When you choose to save in a government savings plan like a 529 plan or a 401k plan, you're subject to all the rules and regulations on those plans. You see, 529s and 401ks, they're a single-use plan, which means a 529, you must use it for college. And a 401k, you must use it for retirement, which means you can't access the money until 59 and a half. Well, here's what I know. After 10 years, 20 years, 30 years, things change. Life happens. What if you need that money to do something else with? Well, I'll tell you what happens. The government takes your money. They charge you a 10% penalty for accessing your money when you don't use it exactly how they want you to use it. I just feel you as an individual are better equipped to figure out the best way to use your wealth as opposed to the US government. Therefore, every family should save money in an account that they own and control. Number 2, families should balance their future savings. You need market risk assets in addition to having safe, guaranteed assets. Unfortunately, we live in an investment world where it's rate of return, get higher rate of return. It's all about the rate of return. And might I show you, that's not the whole story. When you have safe assets, you have more choices. You have the ability to keep more of your own money, and might I even say, get a higher rate of return on your overall wealth. Let me show you an example. Here is a client that has mutual funds, or what we call risk, of $1 million. And let's just say they could get a 5% rate of return every single year. You can see at age 65, there's $1 million at 5%. Well, if that was the case, this client could withdraw $66,252 every single year to age 90. But at age 90, he would be out of money, right? The money's all gone. But I hope all of you understand you cannot get 5% rates of return in the stock market every single year. Sometimes the market's up a little, a lot, and sometimes the market's down. So for our purposes, I am going to use the Dow Jones Industrial Average for the last 20 years. And we're going to put those numbers in. Here's the real rate of return that the Dow Jones has performed every year over the last 20 years. So if I put in those results, we're going to see a different story. If I withdraw $66,252 every year, whoops, I'm now out of money at age 79 or 14 years into my retirement, not 25 years into my retirement. Well, here is the power of a safe asset. What if every time the stock market was down greater than 5%, I did not withdraw from my risk asset? Let's say I took $66,252 from my safe asset. Well, what will this do? So again, we don't know what the market's going to do till the end of the year. So come January 1st, I am not going to withdraw money from my risk asset. I'll pull it from my safe asset. But look at here again. I'm down 7%. So I'm not going to pull money again from my risk asset. I'll pull it from my safe asset. And last time, 16% loss, don't pull the money out of here, pull it out of your safe bucket. Well, like most times when the market declines over a period of years, it will recover. So you can see the market recovered in that fourth year, so at 25%. So I'm going to start using my risk money again. I'm going to keep doing that, but look, we have a negative 33% loss. So the year after, I'm not going to withdraw money from this account. So what you see is instead of being out of money at 79 years old, I actually have $465,000 in my leftover in my risk asset. Well, you did have to pull 66,252 from something. I'm encouraging you to have a safe asset. So we had to pull about $265,000 from another asset. Well, even doing so, what this means is you have an additional $200,000 left over because you had choice, you had balance. You didn't have to use your risk money. This is why you should have balance in your future savings so that we have options when the stock market is down. We go to our safe asset. When the stock market's up, like here, we pull money out of our risk assets. That's the power of balance. And my last belief is every family should own an asset that's completely invisible to the US government for income tax purposes. When you have balance between tax and tax-free, you have more choice and the ability to keep more of your own money. Let me show you what I mean. So this client has $1 million in a taxable account, like a 401k. So the balance of this account is 1 million, but if current income taxes are at 50%, remember you only have half the money. So the value of your 401k or what you get to spend is only $500,000. Now, conversely, if I had balance in my $1 million, let's say I had $500,000 in my 401k and I had $500,000 in an asset that's completely invisible to the US government for income tax purposes. If the current tax rate is 50%, my 401k value is worth $250,000, but my tax-free vehicle is actually worth the whole $500,000 because it doesn't matter what current tax rates are. This is a completely invisible asset for income tax purposes. That means because I had balance between tax and tax-free, I actually have $250,000 more money. Now, this is a chart. It's the historical federal tax rates. And income tax started in 1913. And you can see that income tax has been all over the place. So we have new administrations come in all the time and they change tax structures. So if I have an account that's exposed to taxation and I have very high taxation, I don't have to tap into, we'll say the 401k, and I only have to tap into my tax-free account. We'll wait for a new administration to come in lower tax, and then I can start withdrawing money out of this account. So balance in tax gives you choice and allows you to keep more of your own money. It is a great privilege and joy to help families create future wealth. I wanted you to understand what I believe so you can make better decisions about your financial future. If I can help in any way, please don't hesitate to reach out at monicafelton.com. I'm here to help. Thank you.